Okay. To be clear, I didn't mention it before, I didn't know how much time I have left. So the data that I was looking is only for customers that are physical persons. So there is no corporations or no companies here in the graph. I'm not sure that I understood correctly, but we looked into these, for example, some pairs or these relatively large components and examined each node by node to see who are those persons, why are they connected with each other, and we again concluded that, for example, these were some friends, real world friends and families from some rural areas that it's not likely for someone in some remote part of Croatia to connect to this giant component if those customers are really old or something like that.
But it's all, the conclusion is only based from the data you get from transactions. It's not like, I don't know, some birth papers or something like that to compare.
So the bank has only information that you provided it. If you...
No, just I think it will be a fun research.
Yeah, we know the age, the date of birth, and some other demographic data, and we can see your name, real name, surname, address, and something like that. So we for sure concluded that these, for example, the tightly connected closed organizations, these people all live on the same address and are, for example, are around same age. So they are all, the real data, we really concluded it's from the real data that customers provided us with. Yeah.
Is there a correlation between spending power and component size?
I'm sorry, I didn't hear.
Is there a correlation between component size and spending power?
Spending power. Really interesting topic. We didn't look into the spending power and correlation between the component sizes and other customer features. That would be a really interesting thing to look, and thank you for the idea for my further research. Yeah.
Since you mentioned that you mostly track transactions between accounts, did applications such as KEX and other transaction applications decrease the efficiency of the model you track?
Yeah. Unfortunately, due to the some secrets between the banks, we cannot see the transactions that these nodes had if the connections were not with our customers. So these with KEXPay, how that transaction looks. It looks like the sender, for example, is our customer, but the receiver is a general account KEXPay. We cannot be sure to whom our customer actually paid the money. So yeah, that was a really bummer, but we worked with all we had. So yeah. Okay. Any more questions?
No more questions.
Okay.
I have got a question regarding the initial topic of the social network analysis. Do you perhaps use the K-trust or K-core concepts?
K-trust and K-core.
K-trust. That's like the idea is to find something like a click. A click is really expensive to find. It's not possible to find all the maximum click in phenomenal time. So the core and the trust are easier to find.
didn't perform that kind of analysis, but if you would like to give me some more information, and maybe in some future we will look at that analysis as well. Sorry.
Okay.
Yeah. Okay, I think that's all. Thank you all again for your information.
We can conclude with the lecture. Thank you.
Okay.
Okay, now we can actually have a question.
Yeah. Go ahead.
Does a click need to be fully connected for it to be important?
Uh,
Like if you have a giant click of like 10 nodes and there's only one connection missing, it's still not a click. Do you
it's
ignore
still,
that?
technically, it's not a click. So here in our analysis, we looked just for the clicks. However, these structures may really be indicative for the propagation of information and still be utilized for information flow or some other maybe discounts, because that not fully connected click that is still not sparse has some other smaller clicks. If you understand.
So do you have like a coefficient of how connected a click is?
So if a click, let's say that not fully connected click of 10 nodes, if we have that kind of structure, if it's not fully connected, there are still some smaller clicks within that 10 nodes. Yeah. So that structure of 10 nodes is still important to us. And we can still give some or develop some discounts for the smaller clicks within the structure. Yeah.
So you consider that pretty much like it is fully connected?
Actually, no. But we consider it. We still look at the transactional data. We can see that hey, these are really friends in the real life. For example, they send money for lunch or parties or something like that. But here, for the traditional complex network analysis, the main point is to try to find the clicks that are fully connected. Yeah. Okay. That's all. My name is Maya, and I work in an insurance company, as you can see on the slide, as head of equity and credit analysis. And I was invited here today to share my insights about the landscape of institutional investment. So let's go through the agenda. I will talk about the markets, so what's happening on the markets in terms of what are investors focused on. Then we will go through investment fundamentals, investment process, key concepts, methodologies that are being used in terms of investment decision making, and the last thing will be related with environmental, social, and governance trends that are actually highly in focus and how they actually impact the investing. Let's start. In terms of markets, what's now hot topics, still major topic is around inflation and everything related with the strength of the economies. So all of the key macroeconomic indicators that can actually show if the inflation is going towards the target of 2% and if the economy is actually resilient enough to endure new environment of higher interest rates is being watched. So everything from consumer strength to labor market resilience, then also the state of financial system in terms of banks, and what's happening here. Can we see some kind of signs of weakening as, for example, commercial real estate in the US? And then also what kind of influence this new environment has on national debts and similar topics. Then also what's being watched is geopolitical and political tensions. So they also have significant influence on economies and then consequently on the markets. 2024 is the election year. I think that around 80 countries is having elections this year, so a large amount of population on a global level will have to vote. That's also important because of these political situations. And then, as Western countries have issue with inflation and interest rates because of that going up, China is having problems with deflation and property market issues that are actually connected with weakening demand and questions how to actually activate it back again. Then also liquidity in the system. Liquidity means that we had long periods of quantitative easing, meaning that central banks were actually supporting the markets in terms of enlarging balance sheets, and now we have opposite influence in terms of quantitative tightening, and central banks are actually shrinking their balance sheets, and that's also something that can have significant influence on the markets and prices. Then everything around regulation, ESG is very much in focus in terms of Europe, but also all of the other regulatory guidelines and frameworks are being constantly watched. And of course, stock markets. Here you have to look and take into consideration what kind of sectors, regions are maybe being overpriced or underpriced, and here definitely in focus is Magnificent Seven and big tech companies, because as you can see on the graph, when you compare the index and the S&P technology, you can see that the large percent, almost all of the growth that happened during 2023 was related with big tech companies. So S&P has 500 companies and 10 or 15 did all of the growth. Okay, now let's go into the understanding how investments in institutionals work.
When we are talking about the basics of institutional investment, we have to go to the source, and that source is actually related with all of us as individual investors. In what terms? Well, we as individuals create communities, societies, and in that way we actually want financial system to be secure and stable. And that's why we have this legislative and regulatory frameworks. Within those limits, institutional investors need to operate. And then within those guidelines, every institutional investor needs to pose itself a question: how and why do we invest? Then first, the answer will depend upon the investor profile, meaning that you have to know and understand what is the underlying business model. We will talk about that a bit later. And then also investment philosophy. Investment philosophy means that as each and every one of you and me, we have our core beliefs and value system. It's the same with institutional organizations. And you can see it actually from high-level perspective, how, if you compare development banks with commercial banks, different insurance companies, pension funds, and so on, you can kind of see that they have different goals and ambitions. And then the other side, when we think about business models of institutional investors, all of actually the goals and the financial ambitions of individual investors are actually being transmitted and transferred into the business models of institutional investors. And now we will go through more specific example of the investment within insurance industry. And here, what would be the goals and the role? So first, and the obvious one, is that every investment department, every investment division wants to achieve some kind of best investment return. But in insurance industry, we'll see the specifics of variables that you have to take into consideration when you are actually trying to make this optimal or best investment return. So here is only to notice that the investment return needs to be within this defined or given investment horizon. I will explain it a bit later. Then also every investment department has or creates its investment strategy. And that investment strategy in terms of insurance industry needs to enhance and support overall business strategy. So all of the operations and planning of the company. Then also there are possibilities related with optimization of pricing strategies in terms of insurance products, and also development of insurance products. And then there are also possibilities related with business model resilience. So you can, through strategic asset management, actually control liability side risks. To simplify how it works, on a simple example, you have to recognize bigger exposures that you have on the liability side and what would be the drivers that trigger those exposures. And then through correlations, you can find adequate financial instruments and assets on the other side. And then through that, you can diminish or annihilate the negative effect if it happens on liability side. So if the claims go up, assets should also go up. And then last thing, everything related with asset liability management within insurance industry, that's very important. So you have to always take into consideration the connection between investment returns and then also claims or cash outflows that are related with claims. Now on this sketch, we will go through and we will position activities from investment department within the organization. So insurance company has its business model. Business model is multi-segment, so you have more segments of business. Then business model represents liabilities that actually arise from core business operations. And then you have assets. Assets are representing paid-in premiums. Now, you will get the information about the investment horizon from liability side. How? Well, we have in insurance companies actuaries, and they assess risks, and they actually make projections of future cash outflows related with liabilities that we have taken through products that we are selling. So that information is given, and then with that information you are actually going to asset side and you are trying to find most adequate financial instruments and vehicles that you will actually connect with those periods. And then this connection of investment universe and investment horizon will actually deliver some kind of investment strategy, and that investment strategy will also have the aim to achieve this